Hello, my name is Richard Cowley, and you are attending the webinar from RM2 on financing EOT transactions. Thank you for attending. So what we're going to do is we're going to go through a presentation. I am expecting this presentation not to last any longer than 45 minutes. It may be a bit quicker. It says there's opportunity to ask questions after the presentation. We are not going to have a Q&A session. I have quite a lot of attendees, and we find that answering questions after the presentation does not particularly work very well. But please submit your questions. You should be able to do it on a control panel on the right-hand side of your screen. If you press on questions, you should have a drop-down box where you can enter your questions. What we're going to do is we will take those questions and then we will pull them all together and then answer them en masse, and we will send all the answers to those people who have attended the webinar. I hope that will meet your requirements. Obviously, if any of your questions are confidential, please make it clear that your question is confidential. We are happy to take those kind of questions, but obviously we don't want to include the answers and the questions with everything else. You will be sent, so you can be sent a PDF version of the presentation, but please let us know if you would like that. My email address is at the bottom, richard.cowley@rm2.co.uk. Just send any requests for the webinar. That will come through next week. We are also recording this webinar, and it will appear, if you would like to listen to it again or you have to drop off at any particular point in time, it should be available from next week on our website and also on our YouTube channel. Okay, so without further ado, we will move on. Just to let you know, this is being recorded from my home. I apologize if there's any dogs barking in the background, but I will try to plow on unless it's a complete disaster. If for any reason we have a technical malfunction, I will endeavour to fix it, and then we will just start again from where I dropped off. It does happen every now and again, but hopefully not this time. Okay, let's move into the presentation proper. So I thought it would be useful just to sort of give a quick summary of what an employee ownership trust transaction looks like, or an EOT transaction. Just for anybody who's kind of at the start of their process. To be honest, most of this presentation assumes a fair amount of knowledge in terms of the actual transaction, but this is just to give you a kind of a basis if you are fairly new to the EOT world. So EOTs, the concept of EOTs was introduced in the Finance 2014. That is important because it's backed by legislation. It means that government thinks that EOT transactions are a good idea, and it means that they are very stable and should be here for the long term. There is the ability in the legislation to review it every 5 years. There was not a review in 2019. I imagine because the government was rather distracted in 2019 on other stuff. But it means that we are due a review, and there are certain bodies lobbying for some changes, but not fundamental changes to the legislation. As a result, I pretty much think that even if things are tweaked, it should stay pretty much intact. So the actual transaction, so an EOT transaction is a way for an owner of a business to effectively sell that business to its employees. Basically, because there's legislation, you have to sort of meet certain requirements in order to be acknowledged as a EOT transaction. The main one is a controlling interest needs to be passed to the EOT. And when we say controlling interest, the EOT needs to own the majority of shares. It needs to have the majority of voting rights, the majority of the rights to profit, and the majority of rights to assets on winding up. So the name Employee Ownership Trust is a little bit misleading, because via the trust, nobody actually owns the shares. It is the trust that owns the shares. The employees are the beneficiaries of the trust. So the shares are bought by the trust. There is no allocation of those shares down to employees. They just sit in the trust, and by and large, there's unlikely for the foreseeable future to be any kind of allocation out of the trust to employees. Employees benefit from being in an employee-owned business by having a profit share via bonuses. Profit shares are actually only really going to kick in once the business has been paid for. So effectively, the shareholder will sell the business to the trust. The trust will be set up specifically for the purpose of buying the company. It will not have any funds when it sets up, and therefore it is entirely going to be funded from the trading company that it has bought. Effectively, it writes a very large IOU to the owners, and this is effectively what we're talking about. So the classic model for an EOT transaction is that the owners will fund the transaction. It is not the only option, and this is what this presentation is about. Because it's in legislation, the government thinks owners selling businesses to EOTs is a good thing. They have incentivized owners to do it, and so the headline in terms of all of this is that owners are entitled to sell their businesses without paying any capital gains tax. Their transaction will create a capital gain. You will need to put it on your tax return. You acknowledge that a gain has been paid, and then you immediately ask for the EOT relief of 100%, so you pay no capital gains. There is a further tax incentive, which is that there is £3,600 of entitlement to employees to receive tax-free bonuses. They will still need to pay national insurance, both employees and employers' national insurance, but basically you don't have to pay tax. That 3,600 will be available as soon as the transaction takes place, and it is renewed every year. So what we thought would be sensible is, so we're going to talk about different methods of fundings, the options of fundings. I thought it might be an idea to try and use a worked example to move through it, in order to also give a bit more detail about how EOT transactions work. So we've kind of done a few parameters on which to base the analysis. So when you decide that you would like to sell your company to a trust, really the first thing to do is one of the first things to do is to establish a price that you are going to sell the company at. And generally speaking, you will do some sort of valuation. It is quite sensible to do a formal valuation by an independent valuer. It is not entirely required. It's just if you get scrutiny at a later date from any of the authorities, it's always very good to have a valuation behind you. Generally speaking, when we're valuing businesses, either as an indicative valuation at the start of a process or as a formal valuation, we will be basing our valuing on profitability of the business. So at the start, we are looking at the measure of profitability, which is called EBITDA. That's earnings before interest, tax, depreciation, and amortization. The way that I think of this is actually it's your operating profit plus depreciation and any amortization added back to that number. In this scenario, we have a profitability of 2 million. Generally, when you're doing a valuation, you might do a weighted average on your profitability over a number of years. This is actually, at the moment, it's really quite difficult to do because there's been so many variations, both up and down, in terms of companies' profitability due to Brexit and the current pandemic crisis. But generally speaking, you try to do some kind of weighted average. We are using a number 2 million. What you do with that 2 million is you are going to multiply it by a number. Generally speaking, with an EOT transactions, you usually expect that number to be between 3.5 and 6.5 times. So for a company which is a mature company, which is not particularly growing, it's not going backwards, but not particularly growing, we would expect the multiple somewhere between 3.5 and 5. It's only when you get above 5 that you're probably looking at a business with somewhat more growth, at least beyond inflationary growth. So, a history of 5% growth. I mean, if you do a third-party transaction, obviously there are, there's kind of a lot of companies which are being sold for a lot of money, well beyond what they're actually earning in profits, and you get multiples well above 10. That doesn't really work for EOT transactions because ultimately you can't forget that the company has to pay for itself. So profitability of a company into the future is really important. If you are not expecting to get very much profits in the next 10 years, then as far as an EOT transaction is concerned, your company really isn't worth that much. So in this scenario, our company is got some good growth, and therefore we've given it a multiple of 6 times. So we simply take the 2 million and we multiply it by 6. This gives us what is known as an enterprise value of 12 million. This is not the end value of the business. We will then say, okay, are there any non-operating assets in the business? So the kind of clients that we've been working with, we sometimes find property, which is nothing to do with operations. It's literally investment property, or sometimes just pure investments where the owners have had spare cash within the business. They've just decided to invest it within the business rather than paying it out as a dividend. Cash can also be a non-operating asset, and this is effectively free cash. This is cash which is above and beyond what is needed for the working capital of the business. It is cash which is effectively doing nothing in the business. That will be added to the valuation of the business. In this case, we got 100,000 excess cash. So you get your non-operating assets being added to the enterprise value. However, if you have any existing debt, that will be taken away from the enterprise value, and we have £1 million of existing debt in the business. As a result, we have got 12 million minus 1 million plus 100,000. So we have an equity valuation of 11.1. The trustees of a trust are required to not pay more than the fair value of the business, and the fair value is generally what a valuer says the fair value is. And therefore the maximum that this business can be sold for in this scenario is 11.1. We are assuming it is going to be sold for 11.1. This scenario, we are going to fund the transaction with the cash, with a bank loan, and with vendor loans, the shareholders basically funding the transaction themselves. Just going in the table below, I could point to the second half of the table because we are going to need to pay 11.1 million to the shareholders. However, that's not all we need to pay. We also need to repay the existing debt, and we will have costs associated with the transaction. In this scenario, we put the cost down at 200,000. This is a fairly prudent cost when you are using bank lending, because bank lending is expensive to get in place, and we'll get more into that as we go through the presentation. Generally speaking, our scenario is saying if you are going to take third-party lending in a transaction, you take the forecast for how much it's going to cost you in terms of advisors' fees, solicitors, stamp duty, conversations with the VAT, with the tax man, and valuations, and then you multiply it by 2, because that's how much it's going to cost to get the bank debt in place. So we need to pay for the equity, we need to pay off the existing debt, and we need to pay the cost of the transactions. It's not 11.1 million that we need, it's 12.3. So the top half of the table says, okay, so how are we going to fund that? We are going to fund it with the excess cash of 100,000. We have gone to a bank and we have asked the bank to give us some funding. Generally speaking, if you go to a bank, the highest level of funding that they will give, they will also look at probably your EBITDA, and they will say, we will give you a multiple of your EBITDA. Generally speaking, the maximum a bank would give is between 2 and 2.5 times EBITDA, depending on the level of risk that they think the business is associated with it. On this one, there are exceptions to that. You may get an offer of a higher loan, you may get an offer of a lower loan. It's not going to go much past 2.5. If you went to a non-bank, you may be able to get up to 3.5. This scenario, we're using 2.5, so the maximum we can borrow from the bank is 5 million. That is what we're going to borrow. So we get the cash. We have now got the funding from the bank. The funding will be put in place before the transaction completes, so that once the transaction is complete, we can draw down immediately on that bank loan. The bank will probably tell us that as soon as you draw down on that bank loan, you have to then clear off the existing debt. So we are still some distance away from the 12.3 million that we actually need, and so therefore, as well as the bank debt, we will need vendor loan, we will need shareholder debt, or previous shareholder debt as it now is. That is almost every transaction. You will have some form of vendor debt attached to it. It is spectacularly difficult to fund the entire transaction, and actually quite risky to fund the entire transaction from third-party debt. It is not something that we would advise. So this is our scenario, and this is kind of the basis on what we will kind of keep going back to this during the presentation. Let's move on. Okay, so now we're just going to go into a little bit of a general discussion about the sources of finance that can be used in order to fund an EOT transaction. And we are doing this in order of what we kind of think is cost of the debt. And it's not only the cost in terms of interest, but it's actually the cost in terms of difficulty in actually getting that debt in place and then managing the debt once it's in place. And that is an aspect that you really shouldn't forget. It is very important if you're putting a third party in debt that you need to take the management of that debt very seriously. So the first one is any free cash. The nice thing about this is that we have had a number of clients which have actually built up really quite sizable cash mountains within their business. Now, ordinarily, a shareholder, if they wanted to take that cash out of the business, they'd have to pay it out as dividends, and dividends are subject to income tax. However, if you do an EOT transaction and you have cash in your business, you can take that cash out as part of the capital transaction. It goes outside the scope of income tax. It goes into a capital gain. And as we've already mentioned, As part of the EOT transaction, you get 100% relief on that capital gain. So, put simply, you can take free cash out of a business completely tax-free. You are going from a potential rate of 45% down to 0 rate. This is the very big benefit of doing an EOT transaction if you have got free cash in the business. So normally when you sell your business, you'll probably be doing it to a third party, which would have the requirement that it's going to be cash free and debt free. And therefore you have to take all the cash out before the transaction. You have to pay income tax on it. The consideration that you then get, you pay capital gains tax on it, and you'll be paying 10% or 20%, depending on what kind of reliefs are available to you. And so the EOT transaction takes that 10% and 20% down to 0%. So free cash is clearly a very, very beneficial ability to do in an EOT transaction. So if we're down to the vendor loan, this is the classic way of funding transactions, and pretty much all transactions are done this way, apart from if you sell your business at a discount, it is possible that you may be able to fund it directly. We have had one of our clients who effectively gave their business away to their employees. They took the cash out of the business and there was no vendor debt whatsoever. The vendor debt, in terms of costs, when we set up these transactions, we generally encourage our shareholders, our selling shareholders, if they're taking vendor loans, to actually charge interest. The reason being was we think it kind of protects their interest. It's not really about increasing their return. It's about basically, you are going to be owed this money for a good number of years. Generally speaking, we think that a EOT transactions which sold at a full fair value is probably going to take between 5 and 6 years to pay off. It may be longer, it may be less, depending on performance of business after the transaction. It's a long time and things can happen. We are aware of EOT transactions where relationships between the selling shareholders and the next generation of directors has changed. So we've had transactions where vendors have lent the trust the funds to do the transaction, which is interest free. If there is a change of relationships, it means that the board, who are going to have to agree to consideration being passed to the trust to repay the loans, they have no particular incentive to actually do that because the money, the loan is free. And this is where you actually say, well, you've got to pay interest, so the longer it stays outstanding, the more it's going to cost you. Also, because relationships can change, the interest being charged could be used as a negotiation tool. Generally speaking, vendor loans are seen as quite flexible loans, with vendors being expected to understand that a business has peaks and troughs in terms of cash generation. When we do these transactions, we set up vendor loans properly, legally, and there will be a repayment schedule. However, we would expect a vendor, if on a particular quarterly repayment, if there simply isn't enough cash in the business, that they will allow the company to defer the loan further. The loan doesn't go away, it just gets deferred to a greater period of time. This links quite nicely into the bank loans because, of course, if you set up a bank loan, you will have a very strict repayment schedule and you will be expected to pay the repayments and the interest on the dates that it's been specified within the loan documentation. If you don't, there will be consequences because effectively you would have breached a banking covenant. Those consequences may turn out to be some kind of restrictive action in terms of the running of the business. For example, they may stop you being able to spend any money on CapEx, or reduce the amount of money you can pay on CapEx, reduce the amount of money, amount of that you can increase salaries, and they will they will certainly give you a penalty interest rate. Possibly the worst thing about this is actually they will then start looking at your business very carefully into the future and be in contact all the time, and will become quite distracting to the running of the business. Banks generally will charge you with base rates the way they are at the moment. It will be between 4 or 5%. Banks are not the only other lenders who are interested in doing EOT transactions. There are specialist non-bank lenders. These guys are generally, their business models are set up to lend to more riskier scenarios than a bank would lend to. So they tend to be more expensive. You are talking about an interest rate between, I don't know, starting at 7 to over 12. However, these guys actually are quite useful lenders because they tend to be a lot more flexible than banks. They are far more willing to talk about things like interest-only loans, which go through to a maturity date with no capital being paid, with the expectation that the loan will just be simply refinanced at the end of the term. Obviously, that is a lot more risky for the lender, and therefore, hence why you get things like higher interest rates. We find, I mean, the process of actually getting third-party loan funding, you shouldn't be misled on this. It is a complex, long, and sometimes pretty frustrating journey, because effectively you have to go through a credit control process in the bank or whichever funder, and it can take quite a lot of time and quite a lot of time from the management in order to supply all the questions that the bank is asking them. Specialist non-bank lenders seem to have flatter hierarchies and therefore seem to be able to be a bit more fleet of foot, and therefore you can get through that process a bit more. We have put private equity investment at the bottom. We have not managed to actually do funding from a private equity on an EOT transaction yet. We have talked to private equity organizations about the potential of doing it. EOT, and so we kind of think there is, in theory, a way that it could happen, but we haven't actually managed to do one, and we're not aware of anyone else who's managed to do it. The trouble with private equity funding into an EOT transaction is that whole sort of EOT model doesn't really fit with the way that private equity run. When a private equity invests into a business, they are generally looking to take a controlling interest in that business. Of course, with an EOT transaction, it's the trust that needs to be in control, and therefore you're straight away up against it. Also, fundamentally as well, private equities tend to run on sort of cycles of 3 to 5 years, and therefore at some point they will want to exit the business, and therefore they will want to sell their shares. This can be quite difficult if they've got a minority interest, although it's not impossible, but it's kind of the timing of the exit which is problematic, where the private equity guys can get their full funding. Private equity also going to be expecting a return of 10% plus, easily, probably more like 20%, and if they can't see the possibility of that, they're unlikely to invest. So it's kind of there as it's possible, but I wouldn't spend a huge amount of time trying to find a private equity buyer on an EOT transaction. So if you go and get third-party funding, you are probably going to have to think about some kind of funding hierarchy, because as you said, if you go and get third-party funding, it is possible to get third-party funding across the total funding of the transaction. It is spectacularly rarely done. It's pretty risky to do because you are basically taking your gearing up to 100% in a business, and you need to service that debt. It's a risky thing to do because there won't be any flexibility in repayments. So what tends to happen, you get third-party funding, your bank debt or your specialist debt will sit as what's known as a senior debt. What that means, it sits in front of anyone else that owes any money to that has funded the transaction. Predominantly, that is going to be your shareholders. Basically, the debt is probably going to be over a relatively short period. We tend to see on these kind of things, it's anything between 3 and 5 years. To be honest, you kind of want it to be quite short because effectively the shareholders want to get their money. So they will get a tranche of money when the debt gets drawn down on, but because the bank debt is going to, the third-party debt is going to be senior debt, the chances are they won't be able to pay off any of their own debt, their own loan, which sits in the trust, until the bank debt is being totally repaid or largely repaid. There are exceptions to this. Banks are not completely unreasonable. So if the company is generating a large amount of money and you just, you're sitting on a big pile of cash, they will allow payments to be made to vendor debt, but almost certainly you will need to get their permission. Interest rates tend to be floating, tend to be based on LIBOR rather than bank base rates, Bank of England base rates. LIBOR is the interbanking offer rate, I think it stands for. Basically, it's linked to the Bank of England rates, but it fluctuates a wee bit more. And they will basically take a spread on that, which will be their margin, and it will be anything from 3.5 up to 6. As I said, in terms of absolute rates at the moment, we generally from a bank would expect them to be offering anything between sort of 4 and 5%, depending on the company that they're offering to. And the senior debt will be paid off, and then we'll move to the subordinate debt. So subordinate debt is, so you've got your funding, the bank will lend up to possibly half of it, depending on what kind of valuation you've got, and then the vendor debt sits behind, generally speaking, or third-party debt. Because of the restrictions by the senior lender, you are probably going to be interest only, so you're not going to have any debt repaid. This is important to understand, because the thing about taking third-party debt, it means it does speed up the repayments to the shareholders, but it means that you'll probably get a large lump sum early after the transaction, but then you may not get anything else for quite some considerable time, and then potentially when you've paid off the first lot of senior debt, if everything has gone well with your bank, it is likely that your bank's just going to turn around and say, well, do you want to go again? Do you want to refinance your vendor debt now? At which point you could potentially clear the entire amount of vendor debt off. If you paid off the senior debt within 3 years, it means the shareholders are going to be paid off in total in 3 years. This is the major advantage of getting third-party funding, is that you can get paid off first. So typical transaction, the vendor is going to be paid off over 5 to 6 years. If you have third-party lending, it can be decreased down to 3 years. The way I look at it, if you get third-party funding, it is good for the selling shareholders because it reduces the level of risk because they get paid quicker. Potentially, it increases the level of risk for the actual entity and for the trading company and the trust, because the senior debt, bank debt, is not going to be as flexible as vendor debt. They will expect to be paid, and it will be putting more pressure on the business. As we said, particularly if you're using third-party debt, the subordinate, the junior level of debt will be something from 7 to 12 interest rates. We would suggest, if you're a vendor and you're funding your business, that you may want to consider actually charging an interest rate of 7%. Again, if relationships did start changing and you just thought, actually, I want out of this, I want my junior debt to be refinanced somewhere else, it's not a discussion you can particularly have with trustees, because there's nothing in it for them to refinance your debt. If you were charging less than they would have to pay when they refinanced it. To be honest, there would probably be a bit of give and throw. You probably have to sacrifice some of the actual loan, as well as having an interest rate to negotiate with the vendor, the trustees, in order for them to agree to any kind of refinancing. This is highly unusual, by the way. And then the private equity, again, just for completion, is there. It's difficult to source. You will have a 20% return, but they will be investing in equity rather than debt. So really, there's more risk to the private equity guys and less risk to the company, but you will definitely have the private equity guys on the business case all the time. Moving forward, so we're just going to go into a little bit more detail about third-party debt. As I said, third-party debt is generally the senior debt within the business, and they will basically fund generally up to 2.5 EBITDA, maybe less. Just an aside, because third-party debt is expensive, and because both the bank and yourselves will be going through quite a process which is costly, we would absolutely not recommend to looking for third-party debt unless you have a profitability within the business of £1 million. And if you had a lower profitability within the business, the chances are you're not going to find a bank who would be prepared to fund you anyway. It's just, that they would look at it and say, well, it's going to be an awful lot of hassle to actually set this facility up. And because we're going to be lending not a great deal of money, there's just not enough return in it for us to make it worth our while and for us to take the risk. And I would say it turns around the other way, that when you add the actual cost of setting up a third-party loan to the interest you're going to be charged, it becomes really quite an expensive bit of funding. So for those businesses which are a bit smaller and not so profitable, really, I would say realistically, shareholder funding is actually the only option that you've got in place. You might be able to get some third-party funding via the trading company if you've got some assets that you can secure against it. But generally speaking, it's not something that we usually get involved with. An awful lot of this interest rates between 3.5 and 6% margin on top of LIBOR. Generally speaking, we're talking at the moment of a 4 to 5% rate. So your closing commitment or arrangement fee is one of the costs we're talking about. So we got 1.5 to 2%. And if my mental maths works right, so on our scenario where we've got £5 million of funding, oh God, my mind's gone blank. You've probably all worked this out. So what is it? It's 40 grand cost in order to get your commitment fee. Plus you've got to pay for a due diligence process. You will also have to pay, as well as your own legal costs, the legal costs of the bank. So the due diligence and legal costs of the bank, I would say that would cost anything up to 50 grand. You're probably going to have to add another 10,000 to your own legal fees in order, because what will happen is that when the bank comes on board, they're going to say, right, let's have a look at your share purchase agreement and the loan agreements that you are setting up in terms of the EOT transaction yourself. Oh, and we've got all these comments because we need a whole load of stuff in there to protect ourselves. And then your lawyers will have to amend the documents that they were going to produce anyway, which adds the additional cost. It is also, you are bringing a third party into the whole transaction, and unfortunately lawyers can't help themselves. When you get two sets of lawyers all talking to each other about legal documents, they will negotiate with each other. It's kind of no getting away from the fact, and it sets up a additional costs. So the loan term tends to be short term with third party debt. There are exceptions if you use a specialist debt provider. You will expect absolutely that there will be a charge over the assets of the company from the third party funder. Very important, you are going to get you are going to get bank covenants if you borrow from a third party. These can be quite onerous because one, you have to meet them, and two, you have to report on them. They should be taken very seriously. If you're effectively, when you're reporting at them, they should, you have to basically send them in within the required deadline. They're not like your own sort of management reporting. It doesn't really matter if you're a day or so late. If you're if you're late with your bank covenant reporting, effectively you are effectively in breach of covenants and might lead to consequences, and your bank will start getting worried about it, which means they will start looking at you. At the bottom it says beware of personal guarantees. It is easier to get funding if you put a personal guarantee. We don't really think that really makes much sense with an EOT, because who's going to give the personal guarantee? If it's the selling shareholder, then it's kind of, they're taking more of a financial risk on this thing than they would otherwise do. So what's the point in going off and getting third party funding? And if you're expecting anybody from the trading company to take the guarantee, that's probably a bit much to ask from a employee of a EOT funded company, and you can forget about trustees taking any kind of personal guarantees. Nobody's going to put their house at risk in order to pay back shareholders unless it's the shareholder themselves. So I'm quite conscious of time. This is taking longer than I don't imagine, so I'm going to have to slightly speed up a wee bit. As I said, these presentation in PDF format will be sent to you. So subordinated or junior debt, most of this is written actually as if it's a third party debt, but most junior debt behind senior loan will be vendor debt. But if you did go to a specialist funder, you may expect to get another 3.5% times EBITDA. Your interest rates being charged will be a margin of 7 to 10 plus in terms of interest rates. So your actual interest would be 7 up to 12%. There are people who offer higher than that, but actually if you're perceived with that kind of risk and that kind of expense, I think it would be not sensible to go down that route. You will have a commitment fee. Commitment fees generally vary both in banks and in third parties. It's all part of the negotiation. In fact, you may get a lower commitment fee if you agree to take a higher interest fee. It's interest charge. There for a longer term, your junior debt may be right the way through to 5 years, 10 years, whatever. And they may be, if you're taking it from a third party, they may be on an they have to be on an interest only basis while there is senior debt in place, but they may go on after senior debt is paid and actually be designed purely to just be refinanced when you get to the end of the term. And that covers the repayment schedule. You will, if you go to a third party, you will have another charge on your assets. It will sit behind the senior debt charge, and you will have to get permission. You will be obliged to get permission from your bank to allow that other charge to go onto company's house. And you get the same kind of financial covenants, but possibly a little bit looser than the bank covenants, because effectively this lender will, by the nature of the debt, will have to be more flexible. So this slide is basically just to sort of give you a little bit more of an understanding. Having worked in businesses which have been very heavily geared, I cannot overstate how important it is to take your bank covenants very serious, your bank reporting very seriously. To do otherwise makes the bank very nervous, and therefore they give you more scrutiny. Plus, frankly, if you don't hit your banking reporting covenants, you are in breach of that covenant, and therefore it can slip into penalty interest rates. But just in terms of the table below, we kind of demonstrated the kind of things that you will be reporting on to the bank. So we've just done, again, our scenario, we've kind of done your EBITDA, we've taken it forward from the one used for the valuation, and we're doing a 5% growth, just flat 5% growth. You have to then pay tax on it now at 25%. And the sort of says, we put it as capital expenditure, but it's basically increase in working capital, which we've increased at the rate of growth as well. So you take all those off and it gives you an idea of what your cash being generated by the business would be. Very simplistic, admit, but just for this scenario. So at the bottom, you then get your total debt. So we know we borrowed 5 million quid, we're going to pay it off over 4 years. But remember, your total debt is your vendor debt on top of that. So in our scenario, after 1 year, we paid off 1.25 million plus the interest. And with the vendor debt, we've still got 10.85 to go. You compare that, you do the ratio of EBITDA, and it says 5.43. Your bank will give you a strict load of covenants, and they'll be more detailed than this, and there will be more of them, but they will have saying, right, in 2022, you need to be less than, I don't know, 5.5 in terms of this total debt to EBITDA. In 23, you need to be below 5. In 24, you need to be below 4, etc., etc., etc. And at any particular point, you'll be expected to report on those on a quarterly basis, and you'll expect to be basically pointing out if you go into a breach. Frankly, if you go into a breach of a covenant, it's best to contact, if you know that's going to happen, it's best to contact the bank early, because they don't like surprises. The one at the bottom, highlighted in blue, is basically a classic cash flow covenant. I mean, effectively, you need to have cash flow, which is at least a cash flow ratio against debt service of at least 1. So in our scenario, we are only just above 1. This is only just a viable scenario. However, this was based on, actually, it's not based on the vendor loan charging any interest. So you can see, in order even just to get to 1, we've had to accept that the vendors are not going to charge any interest while the senior debt is being paid off, in order to allow that debt to be serviced a lot quicker. Again, you will get different requirements in meeting this particular covenant at any particular point in time. Again, you will be expected to highlight to the bank if you're in breach of the covenants. You need to do that because they don't like surprises. Right, sorry that has taken a little bit more longer. Just a reminder that if you'd like to leave a question, we will answer it and we will send it out to everyone. If you wanted to ask a specific and confidential question about anything in the presentation, please answer either by the tab, but make sure it's seen as confidential, or email it to me. If you'd like to talk about anything else, in particular, if you want some advice on your own EOT transaction, please get in touch with me, richard.cowley@rm2.co.uk. So conscious of time, thank you very much for your attendance. I hope this has been very useful for you, yeah, have a great weekend. The sun is out here and I hope it is for you. Thanks very much.